Hello guys, here with the first lesson that we're gonna have about this series to teaching you the setup that you need to know to get profits. Let me tell you something, the market is not an algorithmic chaos. That's a fairy tale sold by institutions to keep you losing. See, there's a war happening every day, smart money versus dumb money. And you know that's retail traders like us. But you learn here to fight with the ultimate weapon. There's a widespread belief that markets are purely algorithmic, that price moves randomly and you must accept losses because price does what it wants. This is false. If the market were truly random, my ex would have stuck to one decision for once. So I just let you know that when you open a position, you're essentially buying a seat at the table, the right to speculate in the market. But here's the catch. If you buy something, you're matched with someone selling. If you sell, you're matched with someone buying. This means every win comes from someone else's loss. It's a zero-sum game. To consistently profit, you must align with the 20% who understand these mechanics, not the 80% following misinformation. So let me explain it differently. When you click buy, you're not just opening a trade, you're buying a ticket to the greatest show on earth. And guess what? For every ticket you buy, there's someone selling theirs. That's the cold truth. Your win is someone else's loss. But here's the golden key. Smart money leaves footprints. And what are those footprints? They're hidden in these three candles. Let me show you the candles that we already talked about this in the previous video. But here's a candle reminder. First, the type I candles. We have the indecision candle. I like to call it the waffler. This candle has wicks on both sides, like I can't decide between Netflix or sleep. It forms when price is trapped between two liquidity pools, usually during accumulation phases. The longer the wicks, the bigger the institutional battle happening behind the scenes. These candles often appear as the first candle in a new swing. Why? Because banks are testing liquidity, hunting stops before committing. That tiny wick you ignore, that's where they took out 100 retail traders' stops. This candle is like my gym motivation, goes up and down but never commits. This shows 70% frequency. And, the appearance of the wicks on both ends, like a spinning top, shows trapped liquidity between two reaction zones, and usually it forms in the first candle of a new swing during accumulation phases. These candles often precede explosive moves as institutions hunt stops before committing to a direction. The impulse candle, the cash printer. This is the moneymaker. It explodes out of accumulation zones, usually after high impact news or liquidity rates. The body is thick. The wicks are balanced. It's a Usain Bolt of candles. And here's the secret. It's often the third candle in a swing, confirming the bank's direction. This is a prototype. Watch for this on Wednesdays and Thursdays. Why? Because by then, banks have built enough positional ammo to push price where they want. And now, we have the reversal candle. This is my favorite. Key candlesticks. These are the kill candlesticks because they leave traces of where major market players enter the market. They also show signs of manipulation as this candlestick is commonly associated with smart money, institutions, large whales, and banks. This highlights and indicates that orders are matched. Stop loss orders are liquidated as well as buy or sell stop orders. This way, major players gain the liquidity they need to enter the market. Consequently, the next move will be to drive the price toward objectives where they can close their positions, either completely or partially. It could be said that 90% of the time these candlesticks are created by major players. Keep in mind that they originate from a valid point of interest and or previous highs or lows. Now we have the candle type B. These ones are not part of our setup like the type A candle, but it is good for you to know about it. This candle is a straight up liar. It shows 1 week like it's committed and then reverses hard. It's the market's version of just kidding. Banks use this to trigger stops before the real move. Yeah, single week only. Price fakes a breakout before reversing a stop hunting. That's for the B1, the fake out candle I like to call it. And now we have the laser beam candle, the B2. No wicks, opens, and drives straight to target. Common during institutional markup phases. Well, no nonsense here, it opens and rockets straight to the target. Rare, but when you see it's like finding a $20 bill in old jeans. This often happens during institutional markup phases. Well, if B1 is a bad Tinder date, B2 is the 1% who actually shows up on time. And now we have candle type C, the ghost. It appears during holidays or low liquidity periods, flat price action, and if seen during active hours, I don't know, maybe check for data errors. These flatliners appear when the markets are closed over during holidays. They're like the quiet kid in class, easy to miss, but sometimes they hold secrets. If you see one during active hours, check your broker isn't glitching. A true type C candle means zero liquidity entered. That's why the rare banks don't waste time where there's no money to hand. And here is how we are gonna validate the reversal candle. This is the first step that we need to follow. The reversal candle is your golden ticket. It must close inside the previous candle's range. If it closes beyond, it's fake, like influencer trading courses. The second step is confirm with previous high-low. These levels are the market receipts. They prove whether banks have enough liquidity to push further. No liquidity, your rejection incoming. Stack liquidity, boom, impulse incoming. And then you have to enter an impulse confirmation. Patience is everything. Wait for that third candle to confirm the bank's direction. Enter here, and you're basically right in their cocktails. Well, not that we are here talking about previous high and low. When considering daily time frames and above, you won't get a clear signal indicating when institutions have injected capital into the market. It can also show that a particular zone lacks sufficient liquidity to absorb the incoming flow. At these highs and lows, only two outcomes are possible. Either a rejection that leaves a wick, or a displacement that maintains the candlestick's flow. In other words, the levels are either rejected or expanded through. When there's a rejection, that's what we call an inversion candlestick. Remember that for a rejection to be considered valid, the price must close within the range of the previous candle. If it also creates an SMT or divergency, that's even better. I will teach you what an SMT is in the next class. So, combining this analysis with inversion candlesticks is crucial. If a candle closes within the range of the previous one, everything is fine. But when is the inversion candle invalid? Pay close attention. It is invalidated if it closes above the previous candle's range, indicating that it has shifted beyond the prior high, which nullifies the inversion signal. At that point, when such a rejection occurs at the highs or lows, our objective becomes the easy extraction of liquidity. This is typically achieved by the candle that rejected or expanded through a previous high or low. This technique helps us understand why price swings occur. It's a basic explanation for these reversals. If you're curious about how these principles apply to other aspects of the market behavior, or wish to explore additional candlestick patterns and their implications on liquidity, we can dive deeper into those concepts. Well, I just want to make sure and be real here. As I said before, this won't make you rich overnight, but stick to these rules and practice on the daily chart, and soon you'll be spotting bank traps like a pro. In 3 months, you won't even recognize the trader you are today. So, save this video, rewatch it, and most importantly, paper trade first. Only take 2 or 3 trades a week, don't skip steps, and if you want all this condensed into real trading courses, check out the link in the description. Remember, Trading isn't a sprint, it's a marathon. And today, you just took your first real step. See you in the next video. Peace.